Round two angel investing Energy X offer in newsletter.
Vivek, so what
Yeah.
happened? I think it's Snack or something like that. They said you could get into a ground level investing into Energy X, right? You don't need investor credentials, right? So
Uh,
I'm very excited because I think it's platinum or something,
yeah.
or rare earth minerals. So I don't know. It's been about half an hour. I did nothing, but I was wanting to maybe 1,500, and then I thought, well, maybe 10,000. But like I said, I did nothing. But then I thought about it. Why are they doing it online? I mean, this must be the stupid people that do this. So then I just but have you heard of Energy X? I threw it in Seeking Alpha, nothing.
No, I have not heard of, but I'm seeing a lot of, I mean, we talked
Scams.
earlier. It's not really, I don't know if it is a scam. Without getting into the details, I would not comment whether it's a scam or not. But there are many, these non-public, like private investment opportunities, like a lot of folks are coming up with and trying to attract more and more retail investors. And there was also an article on, I think, Wall Street Journal or somewhere. It's some of them are like kind of uh, becoming like a Ponzi scheme because their funds had not done well, and now they need to return capital to their LPs. And now they're reaching out to a lot of retail and individual investors so that they can raise money and then return the capital to the existing LPs and all that. So there are so many opportunities in the public market itself that I don't know why we would want to get into these, private uh, investment deals. I get a lot of, these solicitation letters. Even today, someone pinged me again for investing in a startup. And I'm like, okay, what? I don't really have to do it. And so you have to be careful. I also come across many of these opportunities, but like I said, looking at the fact that we have a public market has been doing great. I understand there are fewer and fewer companies than what it used to be, but still, it's much better in a public market. And when you get into these private deals, you really do not know how those are structured. There are fee on top of it, and then you have an illiquidity, your capital gets stuck. There are so many issues. And for what? For maybe a couple of percent alpha on it? Not really worth.
So what this reminded me is our friend, remember? He does his due diligence, but I'm sure he lost a lot of money because I was begging to get in
So
and he didn't let me get in, and I'm very glad he didn't let me get in because I
no,
think he lost a lot of money.
yeah, the thing is that our friend, it's not his money. It's the money from which has been raised by home office and LPs, right? And those LPs only put the money, which is a gamble money, in startups because they already have majority of their money sitting with index funds and all that stuff. So we need to understand how the ecosystem works. We're only so this is, I mean, it looks very sexy on your bio saying I am an investor in PE or I'm an investor in VC, right? I'm an angel investor. And you may be part of a syndicate in investing in companies. It looks great on your CV. It's a it's a great talking point when you go to the dinner parties. Right? But understand those VC firms or even individual VC investor that's investing in, it's not their money. They have received money from LPs, which will be, let's say, pension funds, which will be endowment funds, which could be family offices. Now, those family offices, pension funds, they only allocate a percent of their overall portfolio to be invested in venture funds. And that could be depending on, what kind of fund you are. I know Yale is a little more aggressive. That could be 5%, 10%, right? So what we are seeing is only a very small portion of a much bigger ecosystem. And and you want to invest in that? Great. Invest only that percent of your overall portfolio, right? And that is why, I mean, I just don't want to jump into investing in becoming an angel investor if it is my own money. If it is someone else's money, sure. What's there for me to, take a lottery ticket? If it works out, I'll be a hero. And if it doesn't work out, anyway, it's not my money. And anyway, the people who've given me money, it's their gamble money anyway. So, but it attracts a lot of a discussion. It makes you look great. If you put it on your resume saying I'm an angel investor, but but when it comes to as an individual managing your own money, I would not get into angel investing unless maybe with 5%, 10% of my portfolio, fine. I will not add more to it. So PE is the bane of public companies. I mean, there are what I'm saying is not those private equity firms, but these are a lot of these private investments that have been floating around for last about 3, 4. Especially, I've seen more Ross in last 2 years. A lot of these private investment opportunities, and the reason is because coming fewer and fewer companies, are coming for IPO. They're finding it difficult to go IPO because the situation in the market has changed. So now uh, those funds are finding, another way to get some money. Sorry, guys, I've been under weather for last two days, so I'm my voice may be a little hoarse. And if you have a difficulty in hearing, do let me know. What else? So what do you have for today? Of course, we had earnings, one of the biggest earnings, or I don't know, stock market consider it as the biggest and the most important company on the face of earth, the granddaddy, uh, Jensen Huang, Nvidia, they reported earnings. So we'll go through the earnings. Other earning I want to go through is the CrowdStrike. As you guys know, CrowdStrike had in mid of July, they had a huge outage. They were one of the reasons of the biggest outage, IT outage in the history of software. And so I really wanted to dig deeper to understand the impact of it. So I'll talk about CrowdStrike and a couple of other stuff. Like last week, we discussed that maybe we should start a series on a fallen angels. So which means the companies that were once considered as a great companies, stocks were flying high, but now has fallen off. So maybe quickly have a look at that. And what else? I was going through the sorry, I was going through some of the comments from our previous session, and I realized I missed addressing one of the comments was on yield max ETF. Uh, and I do see a lot of investors, especially retail ones, getting attracted towards yield max. So might be a good time to revisit yield max. Anyone interested in yield max? I don't know. I think that comment was from T. I don't see T here, but probably someone either had asked T. Who is not? Have you heard of yield max ETFs?
No, can you explain what is yield mix ETF?
Okay, so okay, so we'll go through it. So we talked about it last December once. So this is like a lot of money from retail investors is flowing into this. It has been a kind of a craze among retail investors because it gives you huge dividends. See, brand says, yeah, it's good for dividends. So, but but you need to understand before you invest in these yield max ETFs, I see a lot of investors getting attracted towards it because of a dividend yield is great. So I want to revisit that. It's almost now 9 months since I talked about the yield max ETF. And also other reason why I want to revisit this is there is a dark side of it, which probably even I wasn't aware last year when I reviewed it. And I'm not invested in it, but I want to share that as well. Yeah, these are, I think, few things plus, some stuff around Tesla and I guess some company news, some charts. That's that's on the agenda for today. Probably looks like we may have a thin crowd today because of a long weekend. So appreciate all you guys, those who are here, for spending a couple of hours on this long weekend. You choose to do this, so thank you.
Excuse me, Vivek. You're
Yeah.
totally worth it.
Yeah, I mean, you could see. I am thankful that you could have been anywhere else doing anything else at this point of a time, but I'm thankful that you are here to spend 2 hours. You find it useful. That is great. That's a motivation for me to to do it every week. So thank you. All right, so let's jump into today's session. Before that, any other thing that you have in mind? I guess I addressed the biggest one. NVIDIA is the one. Anything else that you have heard of or want to bring up for discussion?
Can I talk about Alibaba a little bit?
Sure.
Well, see, all of a sudden, there's all these releases. Like they said, the government had a 3-year reorganization, and now, like I brought up last week, they could go public on Hong Kong. I thought they went public, the main stock Hong Kong, like 4 years ago, and now they're saying it's this it takes time to divert. And it's kind of funny how the news comes out, double time. We heard this already, and now I don't know if the stock is going up finally, but I mean it's kind of tricky how this news comes out, Vivek.
Oh, so they were supposed to launch and be available on that interconnect between Hong Kong and the Shenzhen and Shanghai, the stock exchange, on 28th. Did that not happen?
Well, they said they mentioned it, but like in 2018 or something, but now they're mentioning it again, and I'm figuring, what the hell?
No,
They
it wasn't.
already changed over to Hong Kong.
No, like I think we talked about it last week. So 2018, that connection was established, but that doesn't mean every company that operates out of a China or any Chinese company will automatically start trading. You have to go through the process of getting it, making Hong Kong as your primary listing, and then get onto that, what North-South connect, right? So that connect between the stock exchanges in China and stock exchange, the Hong Kong Stock Exchange, that was established in 2018. So you're right. So that connection was established in 2018, but then slowly and steadily, few companies started to actually trading on that connections, right? So Alibaba was supposed to start trading through that connection. One precondition is that Hong Kong has to be your primary listing, which Alibaba did. And I thought their plan was that from 28th, they'll start trading on that connection. I didn't track, did that happen or not? But you're right. Now I'm seeing a lot more positive news on Alibaba. There was a government investigation into Alibaba about its monopolistic practices, and I think that that case has been settled, and probably Alibaba wasn't found at fault. There are some positive news. I didn't get into the details of it, but I recall seeing some headlines that the government investigation on the monopolistic policies that didn't cause much harm. I mean, that's been concluded. So there's a good positive news coming around Alibaba. Yeah, stock has been depressed for many years. Hasn't done good. I think it's barely up from where it got IPO'd. If I recall, the IPO was what, $75 or something, where the stock probably now it is at 85, 83, right? It was all the way up to 319 during the 2021 8 days. So let's see. Let me see if we can go back all the way to 20 years and see where Alibaba goes. Wow, so looks like it had opened around 90 or somewhere now, and now it is back. It's, if you had invested in Alibaba at IPO, you made $0. In fact, you lost money. That's a reality. If you had invested in Alibaba, it hasn't made any money over how many years? We're talking about 2014, almost 10 years, right? But looks like now that tide is turning, and I don't know. I mean, I still hold Alibaba. It's a cheap stock, but I do understand the risk that you have when you're dealing with such companies, and so you position size it accordingly. Yeah, since 2021, every e-commerce and every tech company has been going down. So I think looking at 2021 and the euphoria we had in 2021, I don't think that's the right comparison. But Alibaba hasn't made any money even since IPO. I mean, it's been all over the places, all the way up to $300 when Alipay was about to go IPO, and then that got killed by the government. And then since then, it's been a downward trajectory for Alibaba.
Vivek, hi, it's Maritza. Good morning.
Hey, morning.
So yeah, I've been kind of looking at Alibaba as well, just because of what we talked about the last time about how it's been going to be listed and stuff like that. Now, how are the options on it? Have you ever, sold options against it to lower your cost basis? How are the options on it?
Yeah, I've been on Alibaba and been selling options on Alibaba. There are good, it's a decent liquidity
Okay.
on Baba options. So
Okay. All right, cool.
from
Thank you.
that perspective, I think so because I've been selling options on it, my cost base is like 20% down from where my average stock buy price is, but it's still I'm kind of losing 50% on my overall investment, even with the lower cost basis. But it is what it is, right? I can't help where the stock price go. I can only continue to reduce my cost basis, which I've brought down to 20%, and I'll continue to do it. So let's look at a Baba option, right? So so if you look at, yeah, you get some decent. I'm going to October. September is too close. I'm not be doing any more September ones. I have one currently, a call spread, which once it closes, I'll start doing October. It's not that tight, but it's not too bad also, right? So you have, and there is a decent liquidity on Alibaba, so you don't have too much difficulty in getting in and out of option. Alrighty. Okay, let's jump into today's session. So I don't know if you were tracking that Nvidia one, but this is the stuff that I've never seen before in my life. There are watch parties conducted, and this happened in New York City. The watch party for Nvidia earning result. I mean, it's like as crazy as, if you're watching a football match. When have you ever seen people enthusiastic or excited about companies' quarterly earnings, that they are congregating and meeting at a bar or whatever the restaurant is, and the restaurant has put in CNBC blaring on all the TVs, and there are watch parties being organized, which so that when you see so much of an excitement among the retail investors, and of course, institutional investors weren't there, but this was then covered in media also, that there are watch parties being organized for Nvidia earnings. That's Ross is when one stock determines the future, something is not okay. I completely agree. Right? This is not how the market should be, but I don't know what to say. I was not here in 2000. I don't know, was that the case for Yahoo? Was that the case with Cisco? Someone who has been around longer than me in investing in US market, please chime in. I wasn't here, but maybe, I mean, it feels like crazy on that you're having a countdown. And of course, CNBCs and the Bloombergs of the world will try to cash in on uh, this craze. But yeah, it was like, it's the first time I'm seeing that there are watch parties being organized for a company's earnings results, which are like so boring. People don't even want to talk about investing, and now we're seeing a watch parties being organized. So that got me thinking, which part of the market cycle are we in? I know for Nvidia, we are right here, right? Either thrill or euphoria. I think we are beyond optimism. We are beyond optimism. Excitement. I think we are either on thrill or on euphoria. Yeah, but I don't know. To me, it looks like we are definitely somewhere here for the market. And whenever you have such excitement coming in the markets, it doesn't end well. But Nvidia has proven us wrong. It has proven me wrong. So I don't want to be cocky here and say, hey, everything is bad. We're going to look at Nvidia earnings, but it has been delivering quarter after quarter. But the fact that people are organizing watch parties means you're not going to get the best price. Everyone is watching Nvidia. There is no alpha to be generated by watching the Nvidia charts or Nvidia results. Only alpha that we can get is through our temperament on holding this, in dealing with this, because there is nothing that is hidden when it comes to Nvidia. Ross, it's what people don't realize is that the main use case for AI is reduction in labor. That is true. There was two studies that we had reviewed some time ago. One was from MIT professor, and then another was from Goldman Sachs. And they had a different viewpoint on how much of a reduction in labor could happen. I think the other thing was reduction in labor plus increase in productivity, because I don't think that reduction in labor going to be permanent. It is going to be a redeployment of labor. But that means the person who cannot learn new, of course, they will be out of a job, just like candle makers went out of a job when we had electricity come in. Horse carriage drivers went out of a job when we had car come in, but then we had a newer jobs. So new skills, the human computers went out of a job when we had a calculators come in. But those who will pick a new skill, next generation, there will be a different type of a job. But Ross, this happens with every new technology, nothing new. So I guess that in case of AI, yes, we will see a reduction in jobs, but I guess in a few years, people will learn new skills and we will have more jobs than ever. Like we have seen over many decades, every time new technology comes in, some people will lose jobs, some people will gain jobs, they'll learn new skills. But there have been a discussion around how much of a productivity improvement can it do. Cyrus, can you also do Dollar General's earning report? I did not actually go through Dollar General. I don't have the data yet, but let's see if you have a time, maybe I can pull that on. Another chart. We are expect before that a comment from Ross. Agreed on reskilling, but all other times the population was much smaller. So worldwide population itself is growing. So again, I don't think, and the job loss is happening only in a particular section of, currently in a particular section of society. I mean, the job employment numbers are still strong. So I'm not worried about from the job number. But yeah, the impact of AI, I don't think we even realize right now what the impact would be. All right, another chart. We're getting prepared for a Fed rate cut in September. I think it's given that there will be rate cut. Only discussion is it going to be 25 basis points or is it going to be 50 basis points? So there was an interesting chart that I came across on the compound, which looks at S&P 500 12-month forward 12-month return and the drawdowns after the Fed starts the rate cutting, right? So the red one represents when we actually had a recession, and that's where the Fed had to cut the rate. The blue ones were where we did not have the recession, right? Which is currently the case right now. Generally, your Fed should not be cutting the rate if there is no recession, right? What's the need to heat up the economy or to pump up the economy if economy is doing good? So generally, you will see Fed cutting rates if there's a fear of recession or if economy is going into recession. But there have been cases in the past, like in November 96, like in November 1966, October 1971, where the Fed had to Fed cut the rates even though the economy was not in recession. Right? So looks like the maximum no, something that surprised me was, even though we had a recession and Fed had cut rates, there are many years in which the S&P 500 returned positive. But look at this, November 79, November 1980. Fed cut rates because of recession, and the stock market was still up 32% after a year. 32% after in 12 months. Same case in 1980, 34% after 12 months. That was really surprising. 32% in 1982, 34% in 1974. The blue ones, which is, hey, Fed cut the rates even though there was no recession, just like the case right now. Majority of the time, S&P returned positive. Right? I think there was one year, 1976, when S&P over next 12 months had negative 5%. So on an average, rate cutting, whether it's a recession or without recession, over next 12 months has ended up in a positive net returns, even though in between the maximum drawdown was 11%. So it's not going to be easy, right? Stock market may go down. And I think a few weeks ago, I presented another chart, which was talking about something similar, which is, hey, we might see, I mean, historically, we have seen stock market going down. After the Fed cuts the rate, market will sell off on fear of recession. And then, but 12 months, 24 months is back up. So this is another chart, which kind of tells the same story in a different way. So drawdown will be 11%. Now, so whoever can survive the drawdown may live to see those 12-month gains, which on an average have 11% when there was no recession, which is the condition right now. So it's a volatility is the cost of investing that we will have to pay, and don't get scared by that volatility. That's all I'll say. But this is an interesting chart. I did not expect that even during sessions, market actually had performed great in so many years, right? In fact, more years market has been up than it has been down. So essentially a Fed rate cut, markets are generally gone up after a Fed rate cut, even though initially it might go down. In between, it might go down, right? 32% high, but we had an 8% drawdown out here. So something to take note of. Ross is saying Fed needs to go real slow and easy. Exactly. There is no need to go all in. And sorry, I hope they only do 25%. Sorry, 25 basis points and not go all the way 50 basis points. The market is expecting maybe 100 basis points by the end of the year. We'll see, but there is no need to do any rate cut. I mean, I had tweeted, I think it was last week, I'd gone to Costco It took me like 5 minutes, driving around the parking lot to just find a parking space to park the car. And the Costco has humongous parking lots and still you can't find a space. It's so crowded. We actually, we actually need a rate hike, guys, not a rate cut. Economy is not slowing down. People are still, I think some section of people are spending. Some section of people some section of economy is growing. Some section which is more of like Starbucks or little more discretionary one, those are being challenged, whereas folks might have traded down to the cheaper stuff. So Costco, you can get stuff for cheaper. You can, even if you had not gone before, maybe you can tie with another family, get the stuff for 2 families, and becomes much cheaper. Walmart results stock is all-time high because it sells goods for cheaper, whereas we see Starbucks being challenged, Home Depot being challenged because of housing slowness and all that stuff. So I guess, but I don't think we still need huge rate cuts. Yeah. Another one, timing the market, which is generally known as swing trading. How many of you are swing traders? Come on, don't be shy. It's okay. It's a one form of, I was talking to someone who was actually swing trading. But it's a way to stay in the market, and there are many folks who believe in swing trading. So there was another comparison or a chart that I came across. Let's say you give you $10,000, and we have a condition that you sell at all-time high, because hey, markets are at all-time high. You invest in S&P 500, you sell at all-time high, and then invest that proceeds, that cash, into 3-month T-bill, because hey, you got a cash, you got to earn something on a cash, and then reinvest if the market goes down, right? Which is, hey, I'm gonna sell at high and buy at low. And there was a comparison done that if you reinvest when the market has fallen by 5%, reinvest market has fallen by 10%, reinvest market has fallen by 20%. What do you think? How the results are? Should be doing great, right? You're buying every time. You're buying when the market has fallen down, and then when it hits a new all-time high, you sell it again. And then get back in when the market has fallen down by 5%, 10%, 15%, hold it. S&P 500 is at all-time high, you sell it. Isn't that great? This is what's called sell high and buy low, right? Anyone disagrees? Anyone disagrees with the concept of selling at all-time high and then holding that cash until market falls down and then reinvesting in it? No disagreement? You all with me? How many of you actually do it? Let me ask you. Who follows the strategy of selling all-time high? You guys probably know where I'm going. So this is how the results turned out to be, right? And this is why I can't say enough. Timing the market, don't even try. It's a fool's game. I can't do it. I never try to do it. This is purple is if you just invested 10K and just held it. Not done anything. Don't sell it at all-time high. Don't wait to get back into the dip. Just invest in and just held it. And this is from 1973 all the way to 2021, I guess. Okay. Now this one is at, you can't even see this. This blue line is at when you have sold at all-time high and bought back when the market had declined 5%. The next one is sold and bought back when market has declined 10%. And the worst is that you buy the market at 20% decline. It is completely counterintuitive. Isn't it that the worst strategy is when you buy when the market has fallen down 20%? Shouldn't that be the best one, man? I got it so cheap. I sold it at all-time high, got back in when the markets had fallen down 20%. Because the markets, 75% of the time markets go up. So if you sold at all-time high, you never got an opportunity to get back into the market until the market has risen up way higher than from where you actually sold. So even in this case, so-called selling at all-time high and buying back at 5%, 10%, 20% declines, the data is pretty clear. It's not my philosophy. It's just that what the data shows. But I mean, I've come across many people, even, for you as an investor, it sounds very exciting to sell at an all-time high and wait to buy the dip, right? I'll buy the dip. And last week we talked about if you're waiting for buy the dip, you keep waiting. So this is another chart. It again shows trying to time the market is fool's errand. Don't even try to do it. Only folks who do it exist in YouTube or Twitter. All the great investors did never try to time the market. Okay. Another chart, right? If you have invested in all-time high, I mean, this is what the concern right now is. Should I invest in the market right now? It's at all-time high, right? Not all-time high, but it is not, it's closer to all-time high, right? If you look at SPY, it's almost at all-time high. Oh, no. No, I guess let me go back and see what's the all-time high was. Wasn't it 580 somewhere on 2021? We had a S&P 500 higher. So this is, let's say this is an all-time high, 565, close to 565. Okay. Should I invest? Should I wait for the dip? So there's another chart which talks about investing at all-time high. How did that work out, right? And let's say you picked up the worst possible day to invest in, right before the crash. This one talks about right before the 1987 crash, right? You invested in the market. This is before the dot-com bust, when the markets were at all-time high. This is before the financial crisis, and this is before the COVID, right? And how the market has performed. If your time period is long enough, time is the best healer for use for us psychologically as well as for our portfolio, right? The 4 worst times to buy in the last 40 years were 87, 2000, 2007, and 2020. Since each of these ill-fated buy point, stocks have returned at least 7.2% on annualized basis and have outperformed bonds in all the cases. So I'm still guilty of thinking of, gosh, should I invest? It's an all-time high. Let me hold it in a cash. So it's not easy to do it. It's a difficult stuff to do it, but sometimes you have to just, keep your own emotions aside and just focus on what the numbers tell you for over the last 50, 60, 100 years. Just because today I am in the market is not going to change the behavior just because I'm investing in it, right? So even with all the 4 worst times, if you're invested in these worst situations, right, you're still done very good. You've still been pretty nice, right? 1987, you invested in all-time high. 1987, you still made 10.24% annualized. That's a huge return. So interesting charts. That's what I'm saying. The alpha that we can generate as an individual investor is our temperament. Don't get scared. And of course, don't go too big. Just manage your time horizon and your needs from the stock market properly. It's not get rich quick markets. It's not a get rich quick game. Unfortunately, if that's how we will try to play out, we're gonna lose, and then we're gonna shun the market saying everything is it's rigged, doesn't work. How many times we have seen that? Yeah, hold for long term. Timing doesn't work. Timing doesn't work. That's exactly what I mean. Timing doesn't work. So that brings me to another chart. Tech, telecom, healthcare. Again, I don't know what's going to happen now. No one knows the future. But last 3 years, last 3 times where we had tech, telecom peaked at almost 45% of global equities, right? So we reached 44% of global equities in July 2024. Tech, telecom, and healthcare. Last time it happened was in 1999. Which other sector has reached 44%? Financial has reached 44% in 2008, around 2008, 2009. So there's something to do with when one particular sector becomes much bigger portion of the global equities, and looks like those peaking around 44, 45%. Historically, we have seen that the next few years doesn't work out that great for that particular sector. 1999, 2000, next few years were horrible for tech, right? Tech, telecom, financials and energy were 44%. In 2008, 2009, we all know what happened after that. And now we are talking about same tech, telecom, healthcare is 44%. So, yeah, I'm not saying or predicting anything. It's a fool's game to even try to predict or time the market. But we should understand that right now, this whole particular sector is almost half of the overall global equities. Right? Does it produce half of the economic value? Is that what you need to think about? Look like sine and cos. Exactly. And it peaks at 45%. Sam says, timing mark might not work, but we buy individual shares. My HPQ bought in 2006 barely recovered due to dividend and split. So if you're investing in individual stock, there is a lot more stuff to be done just then depending on the time. When we're looking at a timing, it's mostly looking at an overall economy, because the economy continues to go up. Right? The world's GDP continues to increase, and hence the prices of the collective prices of the companies continue to increase, right? Some companies will fall off by the wayside. Some companies have become extinct, but collectively we continue to have a better lifestyle. We continue to have better technology. We continue to add economic value. So when you're buying an individual companies, that's a different ball game. Then you need to be very close to understand the individual companies. What if you're holding a company that is a blockbuster? It will go extinct.
So
But if
yeah, they went politically correct. Hewlett Packard, they got rid of Mark Hurd.
Yeah,
after I bought the stock.
Yeah, so dealing with individual companies, that is why for retail investors, if you're not interested in following a company, you have no business to hold stocks of individual companies. Doesn't matter who else has bought it. Even if I buy it and come and talk about a company, don't buy it if you are not inclined to follow that company. Otherwise, S&P 500 is there, QQQ is there. The biggest components of I don't think, when was QQQ introduced? Was it before 2000? uh, when was, so this is next, right? So this is, we are talking about 2004 or something. Let's say even if QQQ was introduced before 2000, the biggest companies of those times in the tech and telecom, like Nodal Networks, Cisco of the world, I don't know what other big companies, Yahoo, right? All those have gone bust. Right? Some have become bankrupt, like Nodal Networks, right? MCA WorldCom. But the other companies have replaced them. And that is why, even though I'm interested in individual stock, my biggest holding is SPY. Because let them do the job of picking up the winners. And I don't have to worry about it. I will always have those winners through these ETFs. QQQ 1999. Okay, so is this like last 20 years? Maybe I've gone to 20. Oh, this is last 20 years. Let's go back and go to, I thought I did the max years. Max. Okay, so let's go to max of. Okay, anyway, so I don't know why it disappeared. So that is why, if you're not interested and you don't have a time or energy to follow individual companies, we have such great instrument to participate in the growth of economy. Just stick to those. Stick to SPY, QQQ, or ETFs. Let them do the job of finding the great companies for you, and you don't have, so that you don't have to get into holding bags on an individual company that has now fallen by wayside. All right, so how we're doing year to date? A pretty nice 17.24% on SPY. What else you can ask for? Markets are still doing great. All sectors are in green. Looks like to be very different. I think in August, market is about 2.5%. The first week of August was so bad because of that yen carry trade. What SPY was down 4% or something in a week. And nobody could have thought that point of a time, it seemed very distant that we will be able to recover. And now we have not only recovered, we have actually turned positive for the month of August, right? So 17%. This is on top of 26% last year, SPY. Right? You don't have to, if you just held SPY, you're talking about almost 40%, 50% gains in 2 years. You don't have to go out to do venture investing or try to find out some private deals or trying to go out and pick up some next new hot thing to get 50% return on investment. I mean, unless you're too greedy, and the greed doesn't work in the markets, right? So still, we're doing pretty good. 17.25%, still great. Ramesh is saying, I bought AMD 99 for $12.50 again in 2017 for $12.69. Now trading for 148. So good thing is that you held from 1999 all the way to 27. Most folks just won't have a patience. They'll just give up. I have seen AMD. I think that was maybe when I just came to US and then about to, understand how the markets work here. And AMD was like less than $5. I have seen AMD less than $5. And I did not know, about the semiconductor and all that stuff. So anyway, and I then from there, I've seen it go all the way to like 150. I went, maybe I should have picked up a few AMDs at that point of a time. Right. But you never know. If you buy, will it turn out to be AMD or will it turn out to be Blockbuster? So you don't want to invest without knowing what you're getting into. So yeah, it went to $2. That's exactly, I've seen it like in a low single digits, but I didn't have a time at that point of a time to go and study individual stocks. So I didn't buy it. And and I'm not from conductor industry. Only thing I knew about AMD was that the AMD chip laptops are low performance laptops when it compared to Intel laptops, right? We don't want to buy, those are cheaper, but then those are not that good from a performance quality perspective. I don't know how factual it is true, but that was a perception that I had. Was if you want a little cheaper laptop, go for the one with the AMD chip because it's cheaper, but you may not get the same amount of a performance what you can get with an Intel chips, right? And now the the scales have turned around, right? AMD is much bigger company, and probably maybe AMD laptops are or their chips are better. Again, I don't have any AMD chip laptops. I don't know, but AMD is doing much better than Intel. Now Intel is having its own existential issues. Vanguard, Fidelity, American mutual funds also doing good. Yeah, same thing. They'll let them do the job. I'm not a fan of mutual funds because of the fee. I would rather stick to ETFs, which are low fee. But yeah, if you cannot do it, let the others do it, right?
Vivek, you were talking about AMD. I've looked at a lot of funds, a lot of high tech. I guess they're users, like they're buying AMD chips. So when would be should we wait for a dip? And how much of a dip should we look for?
Again,
Because what I'm concerned is percentage return, and I don't think AMD will ever give you a decent percentage return.
I have not looked at AMD. So I don't know in terms of the pricing or what's being priced into currently. So maybe I'll take that for the next week. We'll do a AMD quick view to see what's being priced in currently. And do we think that the company will be able to generate that much of cash flow in future? But right now, every semiconductor industry, I think every company in the semiconductor industry is enjoying the tailwind from AI. So it's a more of a story right now than probably numbers. So you'll have to be really careful and make sure that the story actually will play out. Hyperscalers are investing, whether they make money or not. How long can they continue to do it? That's what we need to figure out. So we're going to review NVIDIA's earnings. I mean, it's still great, but how long will this continue to play out? We don't know. So I can't say right now anything about AMD because I've not looked at AMD and never owned AMD. So I don't know. Toss on AMD rocks without glitching. Maybe I'll buy the next one with AMD. Who knows?
So Vivek, for the Intel, I heard something on CNBC last week that they are looking into maybe breaking that business into two parts. One is the chip design and the other is the foundry. Have you heard of that? And what do you think about that?
So Intel had hired one of these advisor Wall Street firms, I don't know, Morgan Stanley, JP Morgan, one of these firms, to look at a strategic options. So market is thinking that there are probably some activist investors getting into Intel and trying to, that's why Intel was up like 6% or 7% on Friday because of that news that they have hired one of these Wall Street firms to figure out how to unlock value for shareholders. So now, as you guys know, Intel has when Pat Gelsinger joined Intel maybe 4 years ago, somewhere during, I know that happened during the COVID timeframe, maybe just before COVID or at the time of COVID, 2019, 2020 timeframe. And he made sure that he told that he wants Intel to get into foundry business, means that Intel will start creating chips not just for its own consumption, but also for other customers, just like TSMC does, just like Samsung does. But that business will need lot of capital. Right? It is not easy to just set up a foundry. You need 40 billion to anyway $100 billion of investment. And this is what the Intel has been doing. They sold off some of them, Mobileye, when they spun up the Mobileye and it went IPO. They sold some of that stake. They recently sold there's another stake that they sold off. So Intel has been trying to raise capital by selling the businesses that is not related to chip manufacturing. But still, if both of them are combined together, it drags down the overall financial results. So what they may be thinking, and I don't know the details, I didn't read through it, is like Sam says, looking to break it apart, make it two separate companies. One which is focused on just designing the chips, which is like what AMD does. AMD doesn't create their own chips. Nvidia doesn't create their own chips. Apple doesn't create their own chips. They just design the chips. And then they work with foundries who create the chips. Like Nvidia, we're going to talk about. Right? Nvidia's all chips are created by TSMC. Majority of the companies use this TSMC. And so now the idea is, if you break those two apart, just on the Intel design side of the house, that can focus on, its business of creating these accelerator, data accelerator, AI accelerator chips, designing chips. Whereas the other portion, which is focused on foundry, that can continue to lose money and maybe raise as a separate company. It becomes a separate financials, go to investors and say, hey, we're looking for a long term. And if you're in for a long term, we want to raise $100 billion, right? But that does not impact or drag down the financial results of the other portion of the house. So generally, when you, if you want to do this, you basically, when you break this apart, the sum of 1 and 1 is more than 2. And that's why the stock probably went up, whatever, 6-7% on Friday, when there was a news or I don't know, rumor around that Intel has hired Wall Street firm to look at the possibilities. And that may be the case. Because this is a long game. It's setting up a foundry business. Even though Pat asked for 5 years, we already 4 years passed, right? What has happened is next year is 5 years, and so.
Vivek, 3 years ago, I remember when sorry, I can't enunciate his name. The CEO came out with vision. I think it was pretty sure it's the CNBC talking heads, but they said, why in the hell is TSMC going to give them their business? And this is a Boeing type of situation, right?
Exactly. So I think the only reason why I'm invested in Intel is it is the only US company that has a capability to create or build chips. Otherwise, we are 100% dependent on TSMC, Samsung's of the world, right? So that's just like Boeing. It is the only American company that can build aircrafts, even though the whole space fiasco recently happened. But that's the only American company. Otherwise,
the reason I brought Boeing is because Boeing gets money to invest in the defense, but they spend it on commercial side also.
Yeah. So anyway, I mean, if you want to be invested in Intel, I think it's going to be a long road. Now they're separating it out as a two separate companies. Probably the design side, the fabless, like Ross said, those are called fabless companies. I mean, fabrication less. They don't fabricate or create their own chips. They just design it. AMD, Nvidia. Intel is, IDM, integrated device manufacturer, something it's called. They do designing. They also manufacture their own chips. So if they break Intel into two separate parts, one is fab, and if fab doesn't work out, it goes to zero, fine. The Intel as a fabless company will still survive. And that might be giving hope to Intel investors. So Niyank, I think that's what you're referring to. All right.
Thank you.
No problem. So fear and greed index, we are now back in green. on the greed side. I think that's all to do with the Nvidia and what's been happening with the Nvidia stuff. So time to maybe take a little rest, do something else. When there's a greed in the market, I want to go a little slow and basically come back when we have a little fear in the market. So last week we talked about fallen angels. So I got two stocks, Ulta and Nike. So let's do Ulta and Nike review from a fallen angels perspective. Again, I don't know what I may be coming across. And I don't have the story behind this. I never owned either Ulta or Nike. I'm not a customer of Ulta products, but I did my market research. If you can say talking to 1% is a market research. I was talking to my daughter, and I know Warren Buffett, he bought $500 million worth of stock of Ulta. But I was talking to my daughter, I'm like, do you guys shop at Ulta Beauty? And this is like your investing thesis has to be narrative plus the numbers. Numbers, we look at it. I don't know what the numbers are, but we look at the numbers. So, but the story that I got was, she told me, Dad, I go to Ulta only if I have a gift card. Someone gave me a gift card of Ulta, then I'll go to Ulta and shop it because they have expensive stuff. So I'm like, don't your generation buy these Ultas? It said, no, it's more of a Gen X or, millennials or above. The new gens, they don't go at Ulta. I'm like, where do those guys shop? They say they look Sephora, yeah, Gen Z, ELF, Sephora. This is where we buy. I'm like, why? And she gave me an insight which says Sephora, and she told me that, this 10-year, 11-year-old, they all go to Sephora. So first of all, I was furious. I'm like, why does a 10-year-old need a makeup kit? Like, oh, you don't understand. This is like, in Insta, you need to look good and all that. Okay, ignore that. Take away your dad's hat, put on your investor hat. And the inside that they say, a lot of young kids, they go to Sephora because they sell the goods at a cheaper rate. I mean, they've got at a price point which the kids can convince their parents to buy. And so if you caught them young, and when they move from middle school to high school and then to college, then they just stick with it. So she told that, that I buy at Sephora, but someone gave me an Ulta gift card. That's the time when I'll go to Ulta Beauty and buy it. Okay. So that's my market research by talking to one consumer of the products, because I'm not a consumer of its products. Ross says Sephora Kids is the rage right now. Yeah, I didn't know about it like until 2 days ago when I was talking to my daughter. I'm like, where do you guys shop for your makeup stuff? And then she told me like Ulta is mom's people. So now if you're looking at the current situation wherein we are seeing little, I won't say luxury, but a little more higher end, right? Starbucks is kind of a level, or Macy's, right? People are trading down to Ross or TJ Maxx, right? Or from Walmart to maybe a McDonald's coffee. So that segment of the consumer is saying, I don't really have to spend, X amount of dollars, because if you look at a credit card, those credit card delinquencies are high. The amount of pending dollars on credit cards are all-time high. So the consumers are trading down. So maybe that's the reason why Ulta shares are down, because those consumer segment that goes to Ulta saying, you know what, this is lower priority for me than doing something for my kids, or for whatever other reason. That consumer segment has a families to take care of. So anyway, let's look at the numbers. So I did a little more enhancement to this one. So Ulta, looking at this is Ulta Beauty, 16.62 market cap company, right? And enterprise value 18 billion, so $2 billion of debt, not too much. To overall revenue, last 12 months is $11 billion, so good amount of a revenue. I mean, it's not that they're like a small company. And net income of 1.2, so close to 10-11% of net profit margin, for which for a retailer is a decent enough margin. Right? 52-week high was $574. Right now it is trading at $352. 52-week low was $318. So let's look at Ulta, and I think $318 was, what happened? Is my voice still okay? I'm just wondering, is the internet connection is an issue? You guys can hear me?
We can hear you.
Okay, thank you. I know today I got a notice from Xfinity. Oh, you're consuming your whatever internet data, 100% internet data. I don't know. Okay, whatever it is. So I think it hit the 52-week low. And then there was a news that Warren Buffett bought it, and then Ulta probably jumped higher after that. Let me see. Let's find it on a Google finance. Yeah, Ulta. Yep, right here. Somewhere was a 52-week low. News came out that Warren Buffett bought a stake on it. Stock jumped higher, and then it's been trading here. So that's a story on that. So let's look at from a business perspective. Does a business, generate it? What's the quality of a business? So I do want to look at 38-39% gross margin is good enough. Look at this return on invested capital, 27%, 30%. The return on invested capital is if you're putting in $1 in the business, how much does it generate? How much return does it generate from business perspective, right? So this is generating, if you keep in $1, it'll generate $1.3 from every dollar that you put into the business, which is great. 30% return on invested capital. Anything above 15% is good. 30% is great. And they've been buying back their shares almost like 4% every year, right? So they've been buying back shares. Operating margin 13% because it is a retailer. If you look at Amazon's operating margin, Amazon retailer operating margin, they'll be worse than what's Ulta's operating margins is. Amazon's all numbers look good because it is AWS. And if they separate out AWS, it's going to be great. Profit margin 10%. Over last 1 year, revenue has grown at 10%. Let's go further down. Growth has been okay, 15 to 20% CAGR growth for 10 years. 24% CAGR growth for last EPS growth for last 10 years. Free cash flow. Let's come back to free cash flow. $990. And their cash flow conversion rate. So this is something new that I want to track starting recently. So I added it new. I don't think I talked about it earlier. But free cash flow conversion means how much of your net profit that you have is actually being converted into free cash flow. That means it will tell you, because net profit is an accounting number, right? You can have a lower net profit or higher net profit based on the depreciation or amortization, right? But you can't pay your bills by amortization. To pay the bills, you need to have a cash. So free cash flow conversion ratio will tell you how much of its net profit is being converted into real hard cash. A company, if it is generating real hard cash, it is very difficult for them to go bankrupt. I've seen companies with a net profit going bankrupt because they don't have a cash. They only have an accounting profit, right? Which is like up in the air. but if you have a free hard cash, it's so 82% isn't enough. It means the other non-cash components in the net profit is not big, right? So I also do want to track this. So and 7% of free cash flow yield. Looking at some of the valuation numbers, PE ratio 13.45 over the past 1 year, average has been 19. Over the past 5 year, average has been 34. So the stock from a PE metric perspective, that's what you follow, is pretty cheap as compared to last 1 year, as compared to last 5 year average. Right? Same is the case for free cash flow. Overall free cash flow generated in past 5 years is 4.5 billion, and they've been pretty consistent in doing close to $1 billion of free cash flow every year, right? So what else? I guess yeah, that's it. So from a numbers perspective, from a business perspective, so far I don't see anything to worry about, right? But let's see. I want to look at the latest their growth and earning report and see what they've done. Are they growing nicely or not? What's the latest stuff on it? So let's go back to our quarterly results. Looking at the revenue growth, they should be a little bit of a concerning. Okay. They've been growing mid-20s, mid-teens. Last 2 quarters, the growth has pretty much slowed down. But it could be because of what we are seeing generally, the commentary that we are hearing from others, like Nike's, like Starbucks, that consumer is being strained. And if Ulta is targeting that set of a consumer, then this may be a temporary phenomenon. Because otherwise, if you look at it, their growth over the now this is 2021, I can go back, but pretty much 20s to mid-teens. It's over the last 2 quarters that the growth is almost stalled. Like recent quarter, it's like less than 1%. Right? So that is something, I think that's what the market got spooked over the last 2 quarters, that, hey, stop growing. But if you think that this is just a temporary phenomena, looking at a longer period business perspective, let's extend it to 5-10 years. They've been around for 20 years, or maybe we can do 15 years, right? They've been managing business really well to generate 20% return on invested capital with a good amount of free cash flow. There's nothing wrong from how they've been managing their business. Recent quarters, they've been having challenges in terms of growing the revenue. Now, if you think that that's the stuff which is completely changes the narrative in terms of they lost it all and they can't recover, then you can decide it accordingly. But otherwise, the company has been able to manage the capital well. So let's look at from a valuation perspective, right? What's being priced in already? So today, so we just need to make sure this matches 7%, 8%. Close to 7.5% free cash flow growth is priced into the stock. That means it will continue to. So first of all, let's say discount rate it's a good company. So I want to have my discount rate at 10%, not really 12%. So what I say is close to 4.5% of free cash flow growth is being priced in. If I want it to so if I want my hurdle rate is 10%, if that's the case, then Ulta needs to generate 4.5% free cash flow growth every year to justify the current valuation. I think it's even less than 4.5%, right? So let's say 4.25. 4%, close to 4%. Have they done that in the past? If I look at last 5 years, they've grown their free cash flow by 10% CAGR. And that's the reason why Warren Buffett may be now interested in it, saying maybe it doesn't grow its revenue, but they know how to generate, how to generate the returns on whatever capital that they have. So that's my Ulta. Don't always look at the stock price. Stock price is depressed, but you go back and look at the history. They've been able to manage it, and I don't think that is this is going to be the only time when the consumer is little stressed. Over the 10-15 years of operations, consumer might have been stressed even at a different points of those 15 years, right? But the business has still been able to generate 20% return on investment on an average for 15 years. So some kudos to management. And that may be a reason why Berkshire Hathaway, I don't know if it's Warren Buffett, might have picked the shares. But if you think that they have lost the plot to ELF or to Sephora and they cannot get back the revenue growth, for that you need to understand how the company had worked during the prior recessions, how it had performed, and how they came out of it. Then I think it's available at a much cheaper valuation. You have a good amount of a margin in this, because right now it's only, they just need to grow their free cash flow by 4% to justify the current valuation. So I would keep it on my watch list because it seems to be a good business, fallen a lot. So if I were to add, and if I'm interested in following a beauty company, seems to be a good business to follow. So that is Ulta. Any questions? All right, let's move on to the next one. Was Nike. Let's go to Nike. Let's pull up Nike. All righty. Okay, so let's see what you find from Nike. Nike is $125 billion company with the sales of $51 billion and net income of $5 billion, close to 10% net profit margin. For retailers, that's good enough of 10% return profit margin. PE almost 22. Sorry, which is not cheap considering it's cheaper than where the SPY is trading, but it's not like cheap, right? It's still higher than the average of S&P over a longer term. Forward PE even higher, so it means probably market is anticipating they're not going to make as much profit as they've done now. PEG ratio pretty high. So from this valuation number perspective, currently it's not cheap, trading at an attractive valuation. Unlike Ulta was like PE was 13. Okay? Unlike Ulta, this is actually still trading at a little more expensive valuation. Right? How much debt do they have? Almost no debt. Sorry, 124, 120. So net debt. When I say debt means net debt, they have a $12 billion debt, but then they have almost $11 billion sitting somewhere in the cash. So net debt is like not even $1 billion. So not a leveraged company. What else? 52-week high is 123. 52-week low is $70. Currently is trading at $83. Trading at close to 52-week low. If you believe in buying at 52-week lows, yeah, it is not too far away. It is what, 10-15% away from its 52-week low, and it is almost 30% down from its 52-week high. So let's look at the quality of business. Last 1 year, trailing 12 months, ROI is 20%. a gross margin, look at a gross margin, still able to generate 40% gross margin. So they do seem to have some brand power. They're paying dividend as well. Why are they paying dividend? I don't know, but maybe the kind of investors that they want to attract need dividends. And they are also buying back shares. Looks like they just closed their year because the TTM and 1 year number are exactly the same. So they just probably they just closed the year. So looking at 5, 10, 15 years, the numbers are not, they're still the same, right? Average. It means they have been consistently able to generate 20% return on capital, which is a good number considering 20% is a good enough from a return perspective. And a high gross margin, nice dividend yield, 1%, 1.5%. If you're a dividend investor, you got a dividend coming in. Plus, they've been buying back shares also. So you got two tailwinds, buying back shares and also getting dividend. What I don't like is like the growth is not much. Growth is not there. So they are returning capital. So the question is, have they exhausted their growth avenue? That's a question that we need to ask ourselves. Other than that, I think they have a free cash flow because if you don't have much to invest in growth, we're gonna return those, have those free cash flow and return in form of a share buyback or for dividend or for paying down the debt. Right? They are growing in a single digits, but that's the case has been CAGR 6% CAGR over last 10 years, 15 years. Okay. Valuation perspective, like I said, is not cheap, more than 25 average PE, but they have never been cheap anyway. 5-year average has been 37. Now, comparatively, yeah, 25 looks cheap, but when it compared with other opportunities that you have in the market, is not that cheap. Right? What else? Yeah. Same is the case with free cash flow. 20 times trading at a free cash flow of average, being able to generate close to $6 billion of free cash flow every year. Right? Now they can figure out what they want to do with the free cash flow. They are paying dividend, 2%, 1.5% of dividend, and then they are buying back the shares. That's what they're using their free cash flow for. I guess that's on the number side. So now let's look at what's being priced in from, let's look at the story side. What's happening with them? Let's look at their revenue growth. Something tells me that all these little higher branded companies are seeing some challenges over the last 4 or 5 quarters that their revenue is being impacted. Some of them could be because of macro stuff, which is impacting other companies also. Some of them could be Nike's own doing. So this, I think the number that I have is for the last quarter. Actually, the revenue was actually down for year over year. And we know what happened to Nike. Nike had pivoted to selling direct to consumers during COVID. And if you look at their quarterly revenue, kind of a stagnated here, right? So it's not a growth story anymore, but could still be a good investment if you buy it at a right price point. Because they've been buying the shares, buying back the shares, reducing the number of shares that's outstanding, still able to generate decent operating margins and been able to generate 20% plus return on invested capital. So it is definitely not a growth story. That shows up in its numbers. It's not a growth story. Last 12 quarters, The revenue is almost stagnated at $12 billion per quarter. Hasn't been growing much. So for a growth investor, probably not for you. It's not going to grow gangbusters. But let's look at, even if it is not a growth investor, I mean, there are many industries that have stagnated, but you can still find good investments in that industry. Right? There are industries that is actually going down, but the stock prices, but the stocks have done well. Tobacco industry has been going down. It's been shrinking, but one of the best performing stocks has been Altria, Marlboro. Railway industry is not expanding, but companies like BNSF, Old Dominion, has been doing great as an investment because it depends on how good are they in generating returns on the amount that they invest in the business and what do they do with that free cash flow, right? So let's look at from Nike from that perspective, see what's being priced in. So over the last 5 years, they've generated on free cash flow CAGR of almost 7%, revenue at 6%. So looks like everything on the top line just kind of flows to the bottom line and to the free cash flow, not too much of accounting shenanigans. 6% revenue grew, you grew your free cash flow by 7%, right? And right now, and if I say that for the next, and what's the next 10 years, say, hey, they're having troubles right now. Their lunch is being eaten by some of the new brand shoes like On, and they may not be able to grow at 7%. Let's say they grow it by 5%, then it is fairly priced. So currently, 5% growth of free cash flow or 5% growth, in this case, I could say revenue because they've been trading in line, is being priced in. The question is, can it do it over the next 10 years on an average to grow the revenue by 5%? If you look at the recent ones, seems to be a little bit challenging, right? Last 4 or 5 quarters. Is this a seasonal one? Because prior to that, they've been done pretty well in terms of growing their revenue 13%, 17%. Okay, we had 4 bad quarters, then 15%, etc. So if 5% it is not too far-fetched, then it is fairly valued. If you think it can do more, maybe 7%, then you have a 15% of buffer in the current market price. So I'll stay at a 5%, then it is fairly priced. I don't think you have too much of a margin. It's like undervalued as compared to what we saw in Ulta. So that's my thesis on Nike again. So few things on Nike is Nike had pivoted from selling, not completely pivoted, but they started to focus on selling direct to consumers during COVID, of course, because there was no other way to sell. Shops were closed. And then and obviously when you're selling direct to consumers, the margins are higher because you cut down all the middlemen, the retailers and all that stuff. So that's a high margin, more profitable way of selling to consumers. Now, the downside which happens because of that was the companies like Foot Locker or other retailers that store Nike's inventory, they started giving that shelf space to other brands. So brands like On shoes, brands like coming from a Deckers, Hoka, right? So those companies took on this opportunity to enter and take that space on the retailers. And now once the COVID, went away, when folks started to go back into the in-person shopping, if you have any questions around Nike, etc., there are not many people on the retailer side who will be able to answer because they don't keep too many of a Nike shoes. And number two, the retailers won't invest in Nike because Nike is trying to go directly to consumers. But if you have questions around Hokas of the world or On Shoes of the world, you will be able to get a direct person to talk to and understand, what kind of a shoe will fit you. You want to run on trails, you want to run on road, what's the size, you want wider, lower. But if you are selling direct to consumer through the website, who's going to answer that question? So these new generation, I shouldn't call generation, but these new brands took that space, and that has caused Nike to lose market shares to these it's called on, something like that. Looks like this again. This is hit among kids. On running shoes, yeah. So now Nike had turning back and say, hey, we want to go with retailers again. Now the question is, how much will retailer play along and all that stuff. But if they fix it, Nike is still a big brand. I don't think it's going to go away in a day or two. They still have, or all the the top NBA players. I don't watch basketball, so I don't know which player wears which brand. Does LeBron James sign up with Nike or Kobe Bryant sign up with Nike? I don't know if Steph Curry is with Nike, but I'm sure they will have one of those, top players. So I don't think we can write it off as much, but because the share price is not too cheap, you want to give them some time to see how they, change their business. But that's the issue with Nike was to pull off the shoes from retailers, and that gave a window of opportunity for their competitors, and they cashed on it. So that's on Nike. Any questions? So I think we talked about two fallen angels. So this is definitely going on my watch list in case if I want to add a shares on my, and again, do this only if you are interested in continuously following this company. Okay. If you're buying Ulta, make sure next quarter or maybe 6 months, once in a 6 months, you go and read his review report. Right. This is, I'm going to wait. So those two fallen angels, next week, we're going to do at the list from our last week. But there are a lot of comment on Starbucks. Starbucks need to put coffee back in the coffee instead of ice. Ross says concept of lipstick index still applies. Yes, this is a new, it's not a new, I think I have heard about this lipstick index. Those who don't know. So there's something called a lipstick index that exists in the market, which tells you that when the consumer feel little constrained, which maybe right now some of these companies, Nikes and Starbucks tells us that the consumer, Ulta tells us the consumer feeling little strained. They will give up little higher pleasures, but they'll trade down and go and buy the stuff that doesn't cost much, like lipstick, and they trade down and get a pleasure out of buying those lipsticks. So there is an index called lipstick index, which tells you, during when the consumer is feeling strained, you'll see the sales of those beauty products at that price points actually goes higher. Starbucks was never about selling coffee, but experience. Yes, that's what they did with a third place. But nowadays, the experience is not good. I've seen Starbucks in Bay Area. Now they have, kind of, it's not boarded, but kind of they boarded those the power plugs, right? So you can't use those power plugs anymore. And I asked one, I'm like, why have you they put a plates on top of it and screwed the plate. I'm like, why are you not having these, allowing customers to use these power plugs? Number one, of course, someone will buy one coffee and sit there for 4 hours, right? That's what the experience used to be. Now, if you can't charge your laptop, you can't sit there for 4 hours. The answer that the store owner gave me was that they were running too much of electricity bill. And I don't know, it's a corporate, probably maybe a corporate mandate at a stores to have people come in, grab their coffee, sit for half an hour, and then get out of it, let a new people come in. But then you don't get the same experience. And why would I pay $7 for the coffee, right? Christian says Starbucks is partially a bank. That's the Starbucks card. They get people put money on their apps. Is there for long term? Yes, I am one of that person. I have a auto reload. Fiscal third quarter show 1.77 billion unredeemed gift card. Yeah, the 9% increase from previous year. That is true, but that's a liability that they have. They can, maybe we should look at the Starbucks and see what's their when the next quarter results come out. Let's see what's their other income should reflect in their other income as an interest. All right, so shall we do Starbucks next year or next week? What other fallen angels? Because Starbucks, what else?
Quick question, Vivek. So, you know how we were talking about Ulta compared to Sephora? I wholeheartedly agree with your daughter. Like, I'm a Sephora girl. I cannot go in there without spending $500. It's ridiculous. But Sephora's not public, but it is the parent company is LVHM or something like that, Louis Vuitton.
Oh, is it LVMH? Okay.
Yeah. So that company, supposedly it is public, but I was just looking on Thinkorswim and the symbol's not coming up. So is it not traded on the US stock exchange, I
No,
guess?
it
or
must
is
be
it
with some Y or something.
French or something? I don't know, because it's a French
No,
company.
no, but it might be on OTC market, so the ticker may be a little different. So,
Oh, I see what you're saying.
okay, hold on. LVMH.
LVMH,
Oh,
yeah.
there we go. It's an ADR with the ticker LVMUY. Its trade is an OTC market, so it may not have options.
LVMUY.
LVMUY.
Now, what about LVMHF? What is the F one? That one's coming up on
I
Thinkorswim.
don't know. My Thinkorswim is dead for whatever reason. Yeah, it has no options. LVMUY because it's a OTC. Generally, you don't have an options on trades on the tickers that trade on OTC market, so it doesn't have.
F is usually generally foreign stocks. Like my BABAF is Hong Kong shares of Alibaba.
Yeah, so there's an LVMHF.
Yeah, so it's probably France bought shares that someone is holding it for you.
Oh, because the price difference between LVMHF and LVMUY is a lot. Like LVMHF, it's at $747, and LVMUY is at $149.
So both of is this an ADR? So sometimes, and again, no, I've never owned this, but what you also need to look into is like sometimes these ADRs, they have
Yeah.
more than one underlying shares under it, right? So HF or UY may be having a different number of shares of Louis Vuitton under it. So that's maybe the reason for pricing difference.
Okay.
Number two is it says SA. And this is unsponsored ADR. I don't know how the unsponsored ADR works. But yeah, LVM. So generally you will see these tickers having H, F, K at the end of it. And I don't know on what basis do they select these alphabets, but then they are not, once they move to, once they're in OTC markets, that's where they have these weird alphabets, tickers ending in these weird.
I just looked it up. It said, I think the LVMHF is one ordinary share, so it's like 750, and the Y one is like 1/5 of a share. That's why it's like
Okay,
1/5.
that's why the difference. Yeah.
Oh, got it. Okay, great. Thank you. Yeah, that makes sense.
So,
All right, just curious. Thank you.
Okay, so I didn't. So this whole area of beauty products, I'm far away from it. I have no idea about that. Sephora is owned by Louis Vuitton. All right. So any stocks did I buy or sell this week? None. Just taking it easy. I didn't have an opportunity. Markets are ripping high, so I want to go slow. So what else? Some charts. Some news. Berkshire Hathaway became the first trillion-dollar company non-tech. The nanogenarian, now 94-year-old, I recently celebrated his birthday. Was it yesterday, day before? A few days ago was his 94th birthday. Now he's 94 years old. Doesn't own a computer. And the company is a $1 trillion company, right? You don't always have to find the next big thing. We don't always have to chase the next hot stuff, right? Berkshire Hathaway, the kind of businesses it owns are the old economy businesses, right? I mean, it owns Apple that sold off 50% of it Apple position, but those are investment side. But the businesses that it owns are insurance. The biggest is the insurance, right? Geico. They own a lot of insurance companies, right? Seas Candies, they still own it. BNSF, which railway. Berlin, yeah, BNSF, we talked about it. They have a lot of energy companies. So, and if you look at last 5 years, Google has only 1 year, 5 year, it has even outperformed S&P 500. Whereas S&P 500 has been driven by all these big mega tech companies, AI companies, and FANG companies, fan mag companies, whatever the abbreviation you want to pick up. But here, steady company run by a nanogenarian has quietly surpassed $1 trillion and have given you a better return than S&P 500, which is majority of the returns are coming from the tech companies. So we don't always have to chase the next big thing. Right? Own a good companies that give you good return on capital, even if they are not growing in business. I don't think the railways or insurance growth in insurance is like 20%, 30%, right? Like the AI is growing like we, but the kind of a businesses that Berkshire owns don't grow. They're like a single digit growth. But even with a single digit growth, you can still run your business and generate 10%, 15% return on capital. Still a good business to own. So that's one chart. There we go. I had another one. Best stocks over last 30-year period. Best performing stocks in S&P 500. So it doesn't include the other outside of S&P 500 from 1994 to December 2023. Monster Beverage. Amazon.com, 33% annualized return. Every 3 years, Amazon stock will double. It's over last 5 years, Amazon, I don't think Amazon done much. Over last 5 years, let's see. I know for last 3 years, it hasn't done anything. Okay, no, it's done decently for last 5 years. It's up almost 100%, which is great. But if you, because right now comparing anything with the last 3 years is a fool's game, because it takes us to the peak of that 2021 euphoria, right? So Amazon number 2, Apple, NVR, which is a residential, of course, Nvidia, Pool Corp, Axon Enterprises. This Axon, have been in and out of Axon. I still don't have I can't still pull a plug, to invest in Axon. And again, when I look at this, I'm like, gosh, it has been a 30% return, annualized return on Axon, but I still don't like it margins. I don't know. I'll have to dig deeper into it. I've reviewed this company earlier. They have a kind of a monopoly in a segment, but the margins are not great. But stock has been doing good. Biogen, Netflix, Ross Stores, Altria, tobacco. We talked about tobacco companies. Market is shrinking. We have a fewer and fewer smokers every year. And this company went IPO in 1985 and have been still able to generate 22% return annualized, right? So how many tech companies we see here? So-called tech company, Amazon, Apple, Nvidia, Netflix. It's a lot of non-tech companies. So over a longer period, I think the quality of a business and how they are able to convert into the returns matter a lot more. Microsoft, Adobe, they are on 21 and 22 numbers. So that's one. What other chart do I have? Tesla. Let's talk about a little bit of Tesla. So few things that I came across, and Tesla is such a divisive stock. I mean, whether you love it or hate it, you can't ignore Tesla. I own a bit of a Tesla in my portfolio. I think I became a shareholder after holding out for a long time. I would only had done options. I don't think I ever bought shares of Tesla until last year. So now I'm a proud owner of Tesla shares. So Tesla's robotaxi unveil that was moved from August to October. Now they'll be unveiling it in Warner Brothers Studios. So maybe we should have a watch party for this one also. I'm sure, I mean, Tesla has probably even more passionate shareholders than Nvidia. And now I think they got a playbook. Someone will organize some watch party, I guess, for this one also. So, so it's gonna unveil and the robotaxi. And if you recall the previous discussions around Tesla, a lot of Tesla market value is dependent on robotaxi, autonomy. Basically, their AI stuff, which drives robotaxis and also which will drive their Optimus robots, the humanoid robots. Elon Musk has told very clearly that if you don't have faith on autonomy, don't be invested in Tesla. Tesla is not, don't invest in Tesla because we make EV. Invest in Tesla because we are the best player or will become the best player in the world for AI, so-called autonomy. Okay. So do we really think and the Tesla is the leader in autonomous driving and robotics? Any passionate Tesla shareholder? I'm a shareholder, but I'm not passionate. I'm a dispassionate shareholder. That doesn't mean I'm anti. I'm just stoic about Tesla. Any passionate Tesla shareholder? What if Tesla is the world leader in autonomous driving and on robotics? If I look around the world, I mean, if you look in US, it is the only EV company, sort of, right? GM kind of pulled back on their plans. Ford is pulling back on their plans. They've been losing money on every car they make. The demand is coming down. Tesla is the only one which is worth being called an EV company. And it is the only company that is focused on autonomous driving. I mean, there are smaller ones, like Cruise is there, Waymo is there, but Waymo doesn't have cars. But this is the only one. But if you look around the world, and last week there was a news around China. So looks like when it comes to autopilot, the Chinese counterpart, especially in China, is ahead of Tesla. So Tesla's inability to roll out the most advanced driver assist feature in China has put an automaker behind its Chinese electric vehicle rivals. Companies like XPeng, Li Auto, they got an approval, but the Beijing has yet to approve the Tesla's latest driving tech.
Vivek.
Yeah.
I saw a South China Morning Post reporter reviewing the Wuhan taxis, right? And then I saw Upton. He's an international, I don't know, guy on YouTube. He reviewed the Tesla taxi in San Francisco, and the Wuhan taxis weren't very capable, whereas the Tesla taxis were capable.
Yeah. So China has moving, and it could be because of the and what you're saying probably is right, because I've also seen the news of the reviews and comparisons, and it looks like some of these Chinese autonomous driving vehicles are performing much better. But
Oh, that's not what
I've also seen that China is allowing fully autonomous robo taxis at many more places than what US is. So the adoption of the fully autonomous driving in China is more than what's in US, and it could be based on they might have a little more lax criteria for approvals, etc. But there are a lot more regions in China, cities in China, in which you're going to have 100% autonomous taxis allowed than what we have in US. So a lot of advancement happening on the Chinese side than on the US side. Other one, there was a World Robotic Conference in Beijing. So when I read the news about it, I'm like, okay, we also have there were 5 humanoid robots that stole the spotlight. And I was going through it, and they talk about, Astribot S1, I think it's making coffee or tea or something. NVDA, it's from China based and they had basically these humanoid robots displaying their capabilities, their skill sets. Looks like someone is washing the dishes. I need this humanoid robot. Okay, well, cooking skills in the kitchen. It'll gonna make my life easier. Wanda. So there was a question of Optimus. Optimus was also there, but it sat motionless in a glass case for just attendees to just take the pictures. That doesn't really bode well if you call yourself if you're betting company's future on autonomy and humanoid robots, and you're saying there will be need for so many billion of humanoid robots everywhere, and we will win the race. If in the World Robotic Conference, you're not even kind of competing there. Something to think about. We need to go and also see, because the world is a global market, we need to see what's happening in the rest of the world also. So I thought I'll share with you both the cases in EV as well as in humanoid robots. So far, I've not seen Tesla leading it from the front. So all the Teslas passionate shareholders talking about it, must gonna do this, must gonna do that. We have a grand plans. I'm a shareholder. But guys, give me the proof. Proof I'm not seeing yet. In this robot conference, why did Optimus not go and display what it is capable of? Only reason I can think of it is that it is right now, it's not even there. It's not even capable of doing what, let's say, the others are. So if you want to be Tesla shareholder, or if you are Tesla shareholder, we need to look for the narrative beyond what Musk is saying or beyond what Twitter is saying. There's a lot more innovation happening in this area outside of US, and they are will start to compete with the same space. So, but good thing is, some good news around Tesla was EU. European Union is actually they're seeing a lot of this. I mean, they don't, Europe doesn't have much of an industry anyway, except some of the manufacturing companies. But EU has decided to slap import duties on the EVs just to, uh, you know, because their local industry is being pressurized by the cheap influx of the cheap EV cars from China. So, but the Tesla had appealed to EU to reduce the overall duty. So Tesla's duty has come down to 9%. So Tesla will now face 9% duty on the cars that are being imported into EU from an earlier anticipated rate of 20%. So that's definitely a win for Tesla. But Chinese company did not get the same amount of love from EU. So BYD, their tax rate was reduced from 17.4% to 17%. Geely's was 19.9 to 19.3%. SAIC from 37.6 to 36%. So at least in the EU, we have some good news for Tesla shareholders, is that, hey, Tesla will be facing less import duty to the tune of 9% as compared to the Chinese counterparts, which are still anywhere between 18 to 36%. So that's that's one good news on Tesla. So October is going to be interesting. So we're going to see what does Elon Musk unveils in terms of a robot taxi. But what will actually happen, we'll get to know in October. But I think Uber is already getting ready for it. So last week, when we talked about Uber and when we looked at Uber tying up with Cruise, that time I made a statement saying, doesn't look like that Uber is talking from position of strength, because number one, Cruise is going to do its own robot taxis. And then they will offer Uber the EVs or the autonomous vehicles. And then, so didn't look like that. And also it was not an exclusive deal. So Cruise can work with any other company also. But since then, last week, looks like Uber has gone on offensive. So we talked about this partnership with Cruise, and then we discussed on Saturday. I might have to change my statement now. So Dara is now on offensive side. 27th, he met BYD chairman. So I expect that we might see BYD cars available on Uber platform. Whether those could be BYD autonomous cars, because the one big chunk of the cost for Uber is the driver's cost, right? That's why the margins are so low. If you look, when we looked at Uber's earnings, the margins were low because a lot of cost. And if you can eliminate the driver cost, it's going to be great for Uber. And then on August 28th, he made a strategic investment in Wave. And basically, so I guess Dara is making Uber ready for the world when maybe Elon will have a robot taxi, because that's going to be a very, very tough market to compete in. If you have a formidable a competitor for whom there is a zero driver cost of software, the marginal cost of software is almost zero, and you don't have any drivers. So competing with those companies is going to be tough. So I guess that's why Dara is probably traveling around the world, forging partnerships with the companies that can supply autonomous driving vehicles that Uber can then list on its platform. So if, but that's probably going to be a bad news for human drivers on Uber platform. Because if I have a choice of a lower cost AV autonomous vehicle and a higher cost human vehicle, as a law, as an algo, I would rather pair up with the rider with a lower cost AV, because my margin also higher in that case. And for the rider, it's coming at a cheaper cost. So that's going to be bad for the human drivers in the long term because they're gonna get phased out and be replaced by AVs on these driving platforms. So the gig economy, those gig workers, especially the Uber drivers, might have a little bit, tough future. But we'll have to see. I don't know. At least in US, we don't see this yet. I mean, it's very restricted places that you can actually hail an AV, but the future may not be far away, and an autonomous vehicle might pull out in front of a driveway to pick you up. And I think Uber is getting ready for that future right now. Okay. So, last two topics. I'm going to talk about. Okay, let me first see. Should we go to earnings or we talk about? Maybe we'll do this next week because I'm also feeling a little tired. Let's do earnings and then we call it a day. I'll talk about the ETFs using derivatives. There are a lot many ETFs coming up. There are some which allow you 100% portfolio protection. So if you see the market is an all-time high, got some ETF for you, which will give you 100% portfolio protection. So let's do it next week. Sorry. And let's go through NVDA and Crowdstrike. And then I'll answer any other questions that you may have. Alrighty. Okay, so let's look at Nvidia. So let me build up, I think. Let's first go here. So Nvidia reported its earnings. There was a watch parties, but the numbers look all great. Revenue of 122% overall revenue to $30 billion. Gross profit up 140%. Gross margin goes up to another 5%. Operating income is up 174%. Net income is up 168%. And EPS diluted is up 170%. Operating cash flow is up 128%. When have you seen these earnings where these numbers are all up by more than 100% year over year? So that's Nvidia for you. They've been executing like crazy, growing revenue, growing operating cash flow, growing EPS, operating income all by 100%, all driven by the hyperscalers who want to build capacity to be ready for AI. I mean, we heard Sundar Pichai, we heard Satya, both talking about the risk is in underinvesting. So we want to invest a lot more. I mean, I saw Microsoft way more aggressive in investing in AI. I see Meta way more aggressive in investing in AI. So yeah. And at the end of the day, when you want to invest in AI, in the supply chain, NVIDIA plays a pivotal role in the whole AI supply chain. This is still the best AI chip it creates. There's no viable competitor to it just yet. So as long as these hyperscalers or some big enterprise who can afford it will continue to invest in AI, I guess NVIDIA will continue to show these results. At some point of a time, the law of large numbers will start to catch up. Once they start to lap this quarter, next year, you may not see that 100%, but still a huge number. Right? Revenue as well as EPS, both were beat from an estimate perspective. Look at the revenue trend. So from the last year, it's been boom, 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 boom. It's like just on a upward trajectory, right? Prior to that, it's kind of had stabilized, but then you got a November 2022. I guess it's this quarter. You have your ChatGPT come out, and then that was like a killer app for generative AI. No one has seen that anything like that before. And everyone, all the big tech companies, they realize that they need to be in it to create the next, to be the platform where the next level of innovation is going to happen. Right? The most important metric is their data center. So they have a, they largely define their revenue in 4-5 categories. One is the data center, other one is the gaming, third is professional visualization, fourth is automotive. Right? These are the 4 major ones. So gaming used to be the biggest one because NVIDIA is known for gaming chips, right? Of course, in between, during 2021, we had a crypto, those gaming chips were being used for crypto. That's different, but they're still the same chips. The GE4 gaming chips used to be the bread and butter, and used to be the one that was gonna made most of the revenue for NVIDIA because NVIDIA wasn't in data centers. Data center battle was being fought between AMDs and the Intels of the world. Right? But now this we have got a Q2 of financial 2022, which means your Q2 of 2021. Are we talking about June 2021? Gaming revenue was more than data center revenue. Q2 of 2022. Now look at this last year. The growth that this had from last year has been amazing. Nothing short of surprising. Haven't seen similar growth as well from any company. Data center revenue is still up 154% year over year. And if you look at 3-year CAGR, it's growing at 123%. All other, even though they've grown 16%, 20%, 37%, doesn't move the needle for NVIDIA. So that's the most important number. The stock was down 6%. Couple of reasons. Stock was up 30% in the 3 weeks. Even though the data center was up 154%, it pales in comparison with what they had done earlier. Right? Earlier, it was up 400% for the past 2 quarters. Right? So even 154% is not enough. This is just the law of large numbers. And then next quarter guidance, they're going to grow 80%. Right? You can't keep on growing 150% quarter over quarter over quarter. Right? But I guess this all numbers look good. Operating margin fine, EPS, net income, balance sheet, they all are pretty good when it comes to NVIDIA. There's nothing to complain about. So that's on NVIDIA's earning results. Then okay, let me just bring up where I had something else that I went through the earnings call transcript. Few things that I want to talk about here multiple times, and I don't think this has been a consistent in communication from Jensen Huang is 2 key revolutions that are happening in the computing world. And he's been very consistent in saying this over the last 3-4 quarters. Number 1, NVIDIA is now in data centers. So 1 trillion of current data center infrastructure is moving from CPUs to accelerated computing called GPUs. And he's been saying this for a few quarters now. How much is this true? I don't know. Someone who manages data centers can tell us, but looking at what hyperscalers are doing, I assume that this may be true. That Intel numbers are not growing, but NVIDIA numbers of data center is growing. So even we don't have a need for generative AI, but if you can get the same GPUs, which are much more powerful in terms of computations as compared to CPU, but at a not too expensive price point, might as well just replace it with the GPUs. At least that's what Jensen Huang is saying. That all the infrastructure that we built in the data centers for over the last 20 years since the internet came along, all that will be replaced. They are moving to replace it from a CPUs to GPUs. And NVIDIA is still the biggest player in the GPUs. Number two, on top of it, OpenAI had told us they created a new industry, generative AI. So that's an additional tailwind in which you have a need for the faster, low power computation chips. Where it's got a, low power consumption, low power computation. So the chips that can do huge computations with less power consumption, again, NVIDIA is leader in this. So these are the two key revolutions happening. Also, there has been rumor around Blackwell, that the Blackwell's launch has been delayed. There are some design issues in the Blackwell. So Jensen Huang did clarify, saying there was a production constraint. So these are my comments. I add my comments that probably was from TSMC. The way what they've done in a Blackwell, they have changed how the previous chips like Hopper were being produced. The design they have changed. Now they in a Blackwell, you got a two chips, then they're going to talk to each other, and a lot of interconnect is happening. So Blackwell is not just even though it's a name of the chip, it's a kind of a systems of a chips. I think I have a note somewhere. What else is Blackwell? Yeah, it's not just a GPU chip. It's a whole AI platform that consists of two chips, co-located packages. Don't ask me what it is. Connect as DPU. Okay, maybe data processing unit. Connect as Bluefield DPU. So it's got more than just a chip on it. It's an overall, call a system on a chip or an AI system. So manufacturing this was a challenge for TSMC, even though TSMC is the best chip manufacturer. So NVIDIA had to change some design so that they can manufacture. So when they manufactured the Blackwell chips, they saw that the yield, which means number of good chips divided by total number of chips produced, was lower than what they were expecting. So you have a more defective parts coming out of it. And it was because it is so difficult to manufacture in the new design that NVIDIA had produced. So NVIDIA actually changed the design. And they said there's no functional change. So we should have these chips ready to be shipped in Q4. Until then, Hopper, which is currently what they sell, the demand is strong and will continue to do so. In Q4, Blackwell will launch, and that will be revenue that will get added on top of Hopper, right? These are the 5 priorities for NVIDIA. If you want to stay invested in NVIDIA, this is what Jensen Huang's priority is for his team. Number 1, CUDA, which is the software libraries to make use of the capabilities of NVIDIA chips. Continue to enhance that library so that, once you're into an hyperscaler or into a customer, you can supply them with the hardware, software, everything, so that customer doesn't move out. Number 2 was a Blackwell. There's going to be a focus, and they got not just a chip, but a lot of other stuff also. Now, this gives me a little worry. Spectrum X, which is basically for transferring the data among the chips. No, I think this is maybe transferring the data from one rack to rack. This competes with my other position that I have in a portfolio, which is Arista Networks. So we'll have to see. NVLink is a very big deal. This is, again, it allows the Blackwell system connect 144 GPUs and achieve 259 terabyte per second in one rack. 4th is generative AI. They're going to continue to build more and more capability to address the generative AI models. 5th is the NVIDIA Enterprise AI platform. So not only it will just supply you with the chips, but it's going to supply with the whole platform, which means your NIMs, and I forgot what's the NIM was. Basically, these are kind of a micro services you can call, and it will run the model and return the results. So NIM agents, blueprints, NIM agent blueprints, etc., which is like a reference architecture, how you should deploy it. So basically all this saying is we want to give a full end-to-end solution to customers to have a AI as a platform. So these are the 5 top priorities. If you're not with any of these, you might want to think of your association with NVIDIA shares. But this is what Jensen Huang's top 5 priorities are. Right. Some new stuff that they talked about was Spectrum X, NVIDIA AI Enterprise, which means include your software, support, SaaS. It's the new stuff that they're doing on. It will exit this year at a $2 billion run rate. It's a huge business, $2 billion in itself. AI Foundry Service, which means basically it'll use Llama open source AI model and have a NIM interfaces. This is a little more technical. You can just call those microservices and you will get access to those models. And agent blueprint, in which developer can use these blueprints to build on top of it and stuff like that. So that's NVIDIA. So they're still taking a lot of market share, and he's not stopping anytime soon. Even though the revenue has increased like crazy so far, he's not stopping. Capital allocation, they still have they bought back $15 billion worth of shares, still at $7.5 billion. And then they announced another $50 billion additional share buyback. So I don't know, I have mixed feeling. Are they doing buyback because they still think the share is cheaper? Because I've seen other cases wherein the management will buy back at the wrong time. They buy back the shares when the shares are nearly high. So majority of the buybacks don't end up doing well for the shareholders. I just hope that Jensen Huang is not. He knows if the value of the business is more than what the market is currently pricing in the shares, yeah, go ahead and buy back. Probably he thinks so. Even though
we have one question. So
yeah,
when he announced the buyback, when the buyback will trigger? How can anybody can know that?
You need to look into SEC filings to know when they will buy it. So there is no timeline of when they will buy it.
So is it like when stock went 95, they already did buyback, or they will do buyback once he announced that?
No, this is so $7.5 billion from a previous buyback authorization is still pending with them. On top of it, they announced board authorized another $50 billion of buyback. So overall, they have $57.5 billion of shares of capital available to buy back the shares. $50 billion of capital to buy back the shares. Why not? How much did they generate?
That can be same like Apple. They keep doing the.
Yeah. So, but Apple, I know the growth has not been happening. Apple, like the kind of a stagnated. So might as well return the capital. Nvidia still buying back the shares while growing the revenue. That's like crazy. All right, so that's on Nvidia. Let's jump on to CrowdStrike, which is little more fireworks because of that.
Did you have CRM?
No, I don't own CRM. Okay. CRM is a good earnings call if you want to jump into it. The CEO is so passionate, but I don't own CRM.
Okay.
CrowdStrike. So when you look at the CrowdStrike, there was less about the numbers, but more about the future, right? From a numbers perspective, they did fine. They grew the revenue 32%, gross profit 32%, operating income almost 190%, net income up 400%, operating cash flow up 33%, EPS is up, beat on revenue, beat on EPS, despite all that fiasco that happened in mid-July. So the market was not. So this is all past, right? It's all about the future is what you're going to do. So market was there are a lot more questions around the future. What's the impact would be of the July 19th incident. So most of the questions were targeted towards that. But before I get into that, let's see what we have now 4 quarters of operating margin, 4 quarters of positive operating margin. Have they turned around the table? I hope so. This company is being trading on story. Margin perspective, not that a great company. If you run through a high quality business, not as yet. Return on invested capital probably is negative. But it's a lot of a growth and it's driven by a lot of stories, and why not? Revenue 3-year CAGR 42%, all numbers look good. Right? So let's talk about what's few things, key takeaways that I saw from an earnings call. First, right at the outset, they talked about what are they changing in CrowdStrike to make the platform more resilient. Enhance visibility and control for our customers. So customer can choose what they want to deploy and when. And I guess they're also going to take a liability of if you did not deploy the latest one and you got had a cyber attack, you're responsible. Enhancements in QA, even for content and configuration. So if you guys recall this whole file that caused the biggest outage, because in a software terms, and I've been guilty of doing the same stuff, we'll say, hey, it's a content change. We're not changing any code, so it's harmless. And that so-called harmless stuff actually caused the biggest outage in the history of IT. So now, looks like they never did a QA on a content change. Right? So now what they said is we're going to change our QA process even for content and configuration. We're going to run it through the same quality process, doing a canary deployment, doing a stage deployment, whatever, as we are doing for a sensor code update. So code and the content. There's a text file and the code file, configuration file, which is you change the parameters, but the code which determine how to use the parameters, both will be traded at a same level. Right? Third, so these two things, I would say, as I was, guys, you should have been doing this right from day one. Right? Involve third party for external review and validation is the only thing I think, hey, I think this is a good thing that you're doing, and I hope you continue to do it for longer. But these two are, they're just catching up with the gaps or the holes in the process that they had it, which they shouldn't have it on the day one anyway. So a lot of questions around July 19th. So this is the overall summary of impact is, sorry, they stopped the pipeline generation. You know, you can't have your sales folks go and knocking on the doors when your name has been plastered on all the news channels saying you caused the biggest IT outage. You can't have your sales folks go and talk about business deals. So they stopped the pipeline generation for last 2 weeks. It happened on July 19th. So they finished the quarter in July. So 2 weeks was the impact. So these were all pushed out to next quarter. Number two, because now this has happened, they expect to see the longer sales cycle, right? So it will not, the deal may not get signed quickly. Lot more scrutiny will be there when you're signing the deal, and it may need much higher leadership involvement. So which means longer sales cycle. They may not be able to upsell to the customers, you know, hey, buy these additional modules from me. Number four is a direct impact of $60 million on commitment packages. This is how you reword it, is like, this is probably kind of stuff where, hey, me a culpa, I'll give you a discount or whatever, you know, you stay committed to me that, you know, you're gonna stay with us, and I'll write off, I'll not charge you, or I'll, give back depending what are the SLAs are. So that's the overall financial impact. It's $60 million, right? So which market thought, oh, it's not a huge impact. They thought the impact would be much bigger. So $60 million over 2 quarters. They've taken $30 million in Q2, $30 million in Q4. New stuff that they talked about, Falcon Flex, which will be their new GTM, which is really helpful because in this case, you just buy it. So when you sign a deal, it has to go through multiple departments: legal, procurement, finance. Every time you add a module, if you have to go through the same departments, it's slow down the cycle. So what they came up with their go-to-market motion is, something called flex, in which you commit a number of dollars, you get it signed by finance procurement. And now how you use the dollars, when you use the dollars by buying how many modules at what time, that flexibility to retain, right? So, and they say the flex is working well with customers. They also want that flexibility. They talk about partnerships. 66% of the new logo is coming from partners. And system integrator business is up 100% year over year. Right? Longer term, the CFO told we should see acceleration business in second half of next year. That means 12 months later. So that means this whole impact, even though they didn't say it, probably gonna last for 12 months. And they still commit to $10 billion of ending ARR by 2031, means 2030 calendar year, fiscal year 2031, $10 billion. That was their commitment that they had made earlier to the street, still holding on to it. Now, I didn't have it here. They also did the guidance. The quarterly guidance suggests 25% year over year. Right? If you look at the guidance that this time they did 32%. So they've already brought down their guidance. The yearly guidance is now 27 to 28%. So I went back and looked at all the previous quarters of the information that we have for Crowdstrike, all the previous yearly growth that we have for Crowdstrike. This guidance is the lowest of all. So they kind of already sandbagging or understanding that this is going to have some impact. I would want to keep an eye on Q4. If you're a Crowdstrike shareholder, the impact may not come in Q3. Because the way the revenue, they calculate the revenue is, you have deals already signed, right? Revenue comes from as and when you do the services against the deals that you have signed. In July 19th, none of those would have been impacted because those are the deals which have been signed long back. Now in Q3 and Q4, the things that I want to focus on in Q3 is the number of bookings or RPOs, which is remaining performance obligations, because that will tell us if I see the bookings going slow or RPO going slow, that means they're not able to sign the more deals. Revenue will be impacted later, but that will tell us an upfront that the number of new deals coming, either the upsell or the new deals is going down. So Q3, watch out for bookings and RPO. Q4, same thing. Q4 is the biggest renewal quarter. And now when it comes to renewal, I'm sure customers will come back on the table and say, let's negotiate. You guys goofed up. Anyway, I was contractually signed up for 3-year contract. Now my 3 year is ending. Why should I sign up with you? Why should I not go for SentinelOne? So we should see in a Q4, which is the biggest renewal quarter, how many customers, what kind of a discount they extract and all that stuff that we should know. So I don't think it's completely out of the woods yet. Looking at a Q2, you can't make any decision because Q2 is based on the deals that are already signed. So that's why the Q2 numbers look all good. Right? So that's Nvidia. Sorry, that's CrowdStrike. Because that brings us to the end. Let me go through some comments. Any other questions that you have? Dot at 12:30. We finished today. That's good. Alrighty. Depend ask, are those stock buyback to give RSUs to employees? So at the end of the day, we should look at how many was a net increase or decrease in the number of shares outstanding. Right? So it's not 1:1. Yeah, a lot of companies do it. They will buy back the shares and then they will give a lot of a stock-based compensation to the employees. And as a shareholder, I mean, they just kind of a window dressing their financial statements. Because if you buy back the shares, it shows up good. Hey, company is doing share buyback. They have a free cash flow. How do you get that free cash flow? By not paying cash to your employees. You gave them a lot of stock-based compensation. And that's how you have a free cash flow. And because you gave a lot of stock-based compensation, you diluted the shareholders. But I don't think Nvidia is doing that. So let's look at Nvidia. Okay, let's look at Nvidia's net free cash flow. So that's why something that I want to focus on is net free cash flow after stock-based compensation, right? After you're given the stock-based compensation, real free cash flow still $12 billion. So yes, they did pay $1 billion of stock-based compensation, but they have so much of free cash flow that they're still able to generate $12 billion of free cash flow. So I'm good for Nvidia. So they have not diluted me, but there are companies I've seen in which the net free cash flow will be negative because they're just window dressing, and I hate that. Ramesh says, sell Nvidia 105 put, keep the premium, don't wait for back. I think I have a put spread with a short put at 110 or something. David asks, do you think Crowdstrike will bounce back from the incident and all the cybersecurity industry scrutiny? Is it safe to invest? And the pending lawsuits? So lawsuits, I'm not too worried about. I mean, right now, there's only one big lawsuit that we are aware of, which is from Delta. And I don't know whether they'll settle down, but I don't think that's going to be a big issue because many of these companies have insurance. So probably insurance will pay up for it. But will there be more scrutiny from industry? For sure. Next month, September, right? So like tomorrow, I don't know when Microsoft got a black eye because of this issue as well. Because Linux systems are working fine. Microsoft systems were the one that had blue screen of death. So Microsoft has called a meeting of all its big partners, including CrowdStrike and government agencies that work on cybersecurity, to talk about how to avoid such incidents in future. How much of even though it's called that this was a change in kernel, it wasn't change in, and now we are getting into the details of operating system, so I'll skip the details. But to look at how much of a changes that these when partners of Microsoft, how much access to the Microsoft operating systems will these partners have or not have, right? So that's a discussion that's going to happen in September. But one good thing I liked about CrowdStrike, little jovial, is looks like there is an award that's been given for the worst stuff of the IT, and that was awarded to CrowdStrike. CrowdStrike sent a senior person, some senior VP, to go and accept that award, and then they have displayed that on their headquarters to remind them that what they did and they should never happen. So they say we're not going to hide behind it. We made a mistake, agreed. We're going to own our mistake. They went, and SVP got an award for the biggest goof up in the IT history. Looks like it's like an Ig Nobel Prize. There's a Nobel Prize called Ig Nobel, which is given to the researchers who work on the things that are of no use to human life. I remember one talk looking at someone has spent years trying to create a theory around when an insect hit a windshield, the pattern of the insects remains. What kind of a physics law it follows? That guy was awarded Ig Nobel Prize. So I guess there is similar prize for some IT goof ups. But good thing is they didn't hide behind it. They said this is a lesson that we'll learn, right? And it'll be a reminder for them that this should never happen. But there'll be more scrutiny, yes. So if you look into the Sentinel-1, I don't own Sentinel-1 but because they're competitor, I wanted to go and see how much have they seeing the CrowdStrike, the tailwind from CrowdStrike. So Sentinel-1 has not changed their guidance yet. They say that a lot of customers have started discussion. They don't want to get tied up in one vendor. So now Sentinel-1 is getting more inroads into the CrowdStrike customers, but their guidance does not include any upside from a CrowdStrike customers defecting from CrowdStrike to Sentinel-1. There could be two reasons. Number one, they are playing conservative. and they want to up their guidance only when they're sure. Or number two, maybe customer says, yeah, you goofed up, but I guess you held our hands and did your best to bring it back to where we are, and we still want to stay with you. So too early to write obituary for CrowdStrike. That's my opinion. I saw class action lawsuit for securities fraud. Oh, this is a standard way of, I mean, this is the cost of being an IPO company. When my employer, when we went IPO, when our company was publicly traded, moment the share goes down 15, 20, 50%, you will see bunch of class action lawsuits. So that's the cost of doing business. I've never seen any one of these lawsuits actually having any impact. So, but lawyers will, anytime the shares will fall down 50%, 25, 30%, you'll see a bunch of lawyers filing a class action lawsuit. They are looking for plaintiffs, but I don't think I've not seen any such lawsuit reaching any conclusion. Buy BUG ETF for cybersecurity. Is this a new one? Because the earlier, I am aware of two, which is Cyber CIBR and Hack. CIBR is cybersecurity ETF, and then another one is Hack. That's also cybersecurity ETF. This is Bug. This is Global X cybersecurity ETF. Their graph all looks like the same. So I guess you just need to pick and see which one are better from an options perspective and which one has a lower expense ratio and more volume, etc., etc. Go with those. All right, so that brings us to the end of today's session. So I guess our yield max discussion will be for next week. Any other questions that you may have?
Thanks.
You're welcome. All right. So I got a Starbucks for our fallen angels. We're going to talk yield max. I'll start with that so that we can cover those topics next week before we jump on to other topics. If you have any topic in mind, yeah, ping me on Meetup, or if you're on Slack, ping me on Slack. And I generally start preparing around Thursday and Friday. So if you let me know before that, I'll be able to include that. All right. Thank you, Ramesh. Yeah, I think today, after this is my third day. Generally, it take me 3 days. So hopefully I should be all back by tomorrow. Just that the weather keeps changing. All right. So it looks like nothing else. Let's stop right here. Thank you everyone for joining in today. And I'm going to see you next week. Bye-bye.